Hello everyone, welcome back to the channel. This is the first video of the valuation series, and today we're going to do a valuation of Intel. So I have a series on the Toolkit for value investing where I go through in a lot of details on how I do my valuation, what is the process, what are the techniques, the methods that I use. So have a look at that playlist if you want to get more information and if you want to learn how to do this. But today I'm going to explain you the analysis that I've done on Intel, and also I will explain you and walk you through my validation and valuation of Intel's business. Okay, first a quick overview of Intel. Intel is the largest semiconductor company in the world. Their revenues in 2020 were around 74 billion. They currently have a market cap of around 204 billion, and they own about 147 billion in assets and have 110,000 employees, and they are based from Santa Clara in California. The main competitors in this space is Samsung. Samsung is actually the second largest semiconductor company in the world, closely followed by TSM, that's Taiwan Semiconductors. They also face competition from Qualcomm, AMD, and NVIDIA. Okay, so Intel has operations scattered around the world, in North America, but also in Europe, Israel, and in Asia. In Asia, they are based in Malaysia, Vietnam, Japan, and also in China. But they only have one facility in China, right? So they're kind of somewhat protected from the current, trade wars and struggles that are, that the U.S. government and the Chinese governments are putting on some companies. So they're kind of well protected of that. And as far as the news are concerned, Intel just announced that they will be doing some huge investments in facilities in North America, in the US. And they also announced they are opening facilities in Germany, right? So they are investing, they are open new manufacturing facilities in North America and in Europe, not in Asia. Okay, so Intel divides their business into two main business units. One is the PC. The first one is the PC-centric business. That's the processors that we all use in our laptops, in our computers. So that's currently is 51% of Intel's revenue comes from that business unit. And then the second business unit is what they call the data-centric business. That accounts currently for 49%. It has been increasing in the last couple of years. And that's all the semiconductors for data warehouses, for cloud computing, for mobility, for the Internet of Things. So everything that it's not related directly with standalone laptops or PCs. Okay. So in terms of financial analysis, let me start by saying that I always do a research on the credit scores if they are available. Okay, in the case of Intel, Intel scores A+, with rated by Fitch. I haven't looked at Moody's, but they usually tend to be very, very close. So Moody's would probably be AAA. So that's really good. I mean, it means that the analysts view the company as really credit worthy. There's no immediate risk of bankruptcy. Also, if you look at the revenues from Intel over the last 6 years, 6 to 8 years, it has been increasing, right? That's the blue line that you see on that graph, revenues from operation, and it has been, significantly rising. And the same with respects to the gross profits, with the operating profit, which kind of was flat between 2010 and 2016, but since then it has been increasing. And the net earnings, so net profits, also flat until 2017, and then more recently it has increased. So it's good to see that the revenues are growing, that the profit margins are also growing over time. Next, we're going to have a look, we are looking at the free cash flow. So again, align with the revenues and with the profitability. Cash flows have been increasing since 2016. Free cash flow also since 2017. The capital expenditures between 2018 and 2020 was kind of flat with a slope downwards, but that's going to change based on the recent news of the huge investments that Intel is going to do on, or it's going to make on new facilities in the US and in Europe. So do expect the capex to rise over the next couple of years, but the expectation is that in the long run, those capital investments will reflect themselves in higher revenues and higher margins. Now, having a look also at the earnings per share and the book value, again, very, very healthy business. This is what you expect to see in a mature value company, where the value to the shareholder, be it in the form of dividends or in the forms of book value, are increasing, right? And for sure the book value has been increased significantly since 2012. The earnings per share have been somewhat flat until 2017, and then increasing after that, very similar to what we've seen with the net profit, of course. And the dividends have been quite stable, slightly increasing over time, but they have not been disrupted or not cancelled. Okay? And then just having an overview also on some of the ratios that we've learned in the first series of videos. So we see that for Intel, their revenue has been on average increasing year on year over the last 3 years by about 6.7%. Their gross margins, this is 3 years average, are around 60%. Their operation margins 32%, and their net profit margins are around 30%. So very, very healthy margins for this company and even for this sector. Next, performance. The return on equity is 26%, the return on assets is 40%, and the return on capital employed or employed capital is 19%. Again, good for mature businesses. It's kind of aligned with the industry, so it reflects a mature business with a healthy pipeline of business and with good performance. And then last but not least, the financial health of the company. Debt to equity lower than 1, that's what we like to see. Current ratio above 1.5, in this case 1.95, so very healthy. Quick ratio also 1.24, really good for a company. And the interest coverage is 40.87. It means that they have enough money, they generate enough cash to pay for interest coverage, so to pay their debt. Okay, so really good company, a company that it's growing over time, that is profitable with good performance and in very good financial health. So on the right hand side, kind of put here kind of a very brief description of the new Intel CEO. So Patrick Gelsinger joined the company in February this year. He was a long-standing employee of Intel for almost 30 years. Intel was his first job. And then he took a few years off where he led other companies. In this case, before rejoining Intel at the beginning of this year, he was the CEO of VMware. He kind of came back to Intel, and he has already put in place a huge investment plan of 20 billion. I mentioned this before. Intel, as you can see from the news, Intel is spending 20 billion to build 2 new chip plants in Arizona. He also mentioned in the interview that he's investing in Europe, in Germany, and it's great to see this type of investments being done, especially being done in the US. So this to say that even though there is a new CEO, it's a CEO that knows this company really well. Okay, he was part of the company. He was the first CTO of Intel before he left to lead other companies, and now that he's come back, I'm very confident that he will do a tremendous job getting Intel into the right track. Okay, so in terms of validating a business, and I explained in one of the Toolkit series the concept of validation and how I validate the company. So I'm going to go pretty quick on the validation. So I have a set of validation criteria that a company needs to meet in order for me to decide that this is a company that I'm willing to invest in. Okay. It's not a weighted validation. I get to decide in the end an overall validation score, meaning that I may decide to invest or not invest. It doesn't depend. I don't need all the criteria to pass. There are some key criteria that I may decide that the business is too risky or it doesn't meet my honor code, and then I might decide that it's not a stock for me, right? So it's a subjective validation in the end, but it's always good to go one by one and see how many of the criteria are met. Okay, so in terms of performance, Intel meets all my criteria for performance, right? They are growing revenues. We saw that in the graph. They have gross margins of higher than 30%, operating margins higher than 15%, and net profit margins that are higher than 10%. We saw that in the last slides. They also meet the criteria for financial health. Positive cash flows, debt to equity lower than 1. They also meet the equity valuation criteria. They have growing earnings per share since 2016. They have a growing book value since the last 10 years, and they pay constant dividend, which have been slightly increasing over time, right? So far they meet all these criteria. Now I go to the criteria of my own understanding of the business of Intel. Okay, do I understand enough of the business to invest in this stock? And in my case, and again, this is subjective to who is investing in Intel. in my case, I feel that I have a good understanding of Intel's business. Not only because my background is somewhat technical, so I do come from the electronics IT sector, so I understand the business, I understand the sector, the industry, and I've also done some due diligences to kind of understand what Intel does and what are their plans for the future. So in my opinion, I think I understand the business of Intel enough to invest in the company. The second one is, do they have any moats or competitive advantage? So this one, I was not sure if I should put it a pass or a maybe, right? Just because they have some quite large competitors. However, having said that, after some research, I found that most of the semiconductors companies, actually, they don't have foundries. They don't build their own chips. Okay, so they design them. They do all the design, all the architecture of the chip, but then they outsource the production, the manufacturing, to either Samsung or TSM, Taiwan Semiconductors, or some other companies in China. Intel is one of the few companies that are vertically integrated, so they do everything. They design the chips, they manufacture, they distribute it, they sell it, they do everything. So I think they do have a competitive advantage. Maybe not as it's not a monopoly. Okay, so they do not have the monopoly of being a fully integrated company. Samsung and TSM also do that. However, I think that nevertheless they still have a moat. They do have a competitive advantage. So in this case, I'm going to say yes, it's a pass. I've already mentioned the new CEO. I think they do have a competent management. And last but not least, they meet my honor code. So I've talked about my honor codes in a video before this one. It has to do with the types of companies that I morally not willing to invest in. So watch, there's a video called Portfolio Management. I'll put a link in the description. So watch that video, and you'll see what I mean by meeting my honor code. But yes, Intel meets my honor code. So overall, looking at this, I mean, there's no other option than to just say, yeah, overall validation of the business. Intel is a company that absolutely, yes, I would be willing to invest at the right price. And that brings us to the next step, which is how to value a business. Before I do a business valuation of Intel, full disclosure, I do have a long position with Intel, so I own Intel stocks. Okay, and some of the reasons, one of the reason why I own Intel stock is because it seems to me, in my opinion, a great business. And that's it. So looking at some of the assumptions that I had to make in order to do a valuation of Intel. Again, I have a video on the Toolkit series where I explain in detail how I value a company. Okay, actually the example is with Intel, so I'll put a link in the description. So if you're interested to know how I evaluated Intel, go and watch that video. So the assumptions that I had to make in order to do a valuation was, what kind of revenue growth do I expect Intel will have in the next 5 years? looking back at the history, what has been the operational cash flow to revenue, and what has been the free cash flow to operational cash flow ratios. And those are the ones that were the average of the last 5 years. So I took those. In terms of revenue growth, I took 6% revenue for the next 5 years, my estimate for Intel's revenue growth. Then I need to assume an equity risk premium. Okay, so this is the equity, I mean the return that I'm expecting if I invest in Intel, that I am expecting Intel to generate in the next 5 years. And then last but not least, I need to assume a free risk rate for the discounted cash flows, and in my case I decided to go with 2%. Now currently the 10-year Treasury bill is below that. It's at 1.7. okay, I think it's going to rise in the next couple of months, so I've decided to use a free risk rate of 2%. okay, so when I use these assumptions and I input them into my discounted cash flow methods, I get a fair value for Intel of $88.56. okay, I explained that before also in the valuation video. I then use a second method based on Professor Damodaran spreadsheet to calculate the estimated value per share based, using his method. So that kind of gives me an idea, of how wrong can I be, and also kind of allows me to choose a level of confidence on my valuation. Okay, and in this case, my level of confidence, because it's very, very close, the value of the two methods, my confidence level is 80%. I never go above 80%, by the way. Which means that I then can decide what is going to be my margin of safety. And in this case, for Intel, based on my assumptions and my valuations, I have a 20% margin of safety. And that brings me to the value or the price that I would be willing to buy Intel. Based on all these assumptions, I think a good buying price for Intel would be $70.85 or anything below that. I would be willing to buy Intel at that price, or lower, ideally lower. Okay. So I hope you enjoy this video where we cover the Intel valuation. I'm going to make some additional videos with valuations on other companies. If there is any company that you would like me to do a valuation on, just put it in the description below. Okay, and if you like this type of videos and if you like this type of content, please give me a thumbs up. That will let me know that there's people out there that like this type of information, that like my videos, and I'll keep on doing them, right? So please give me a thumbs up. Also, if you want to be notified on the next upcoming valuations, click the subscribe button and the bell icon, and you'll get notified when I upload the next video. So that is all for today. Thank you very much, and stay safe out there.